All right, everybody, welcome to chapter 20. Chapters 20 and 21 deal with budgets. So we're getting farther and farther away from accounting, aren't we? No journal entries, T accounts, anything like that. We're talking about budgets. And this is probably a topic that you discussed in your management classes as well. Budgets are important to not only your personal life. I'm sure, well, I hope you all have budgets for this and that, but budgets are definitely important for a business. One thing that's very important in business is planning. You don't want to get caught, poor business management, results in being caught with not enough inventory to meet customer demand. This chapter, we're going to be doing production budgets, materials budgets, cash budgets, all kinds of budgets. And I think this will be easy for you. I think this will be a lot of common sense. Budgeting is a process of planning future business actions and expressing them as formal plans before the year begins. Before 2021 began, companies were budgeting for what was going to happen in 2021. We can focus on future opportunities and threats. If we see in the market, hey, these are becoming really popular, we should think about trying to offer this product. Or threats like COVID, for example, we can plan on how we're going to survive this. And after the year is over, we can look and see, did things turn out like they were planned, like we were planning in the budget? We can evaluate our performance. Did we live up to the budget or did we fall short? And when you give your employees a budget from the very beginning of the year, they know what's expected of them. And when the year's over, you can evaluate your employees on how they achieved the goals, because budgets are basically setting goals. Each department is going to have a budget, and these budgets are going to work together toward the company's overall goal. For example, the sales budget is how much sales we want to make. Well, that's going to determine our production budget, which tells how much we're going to produce. And budgets can be a positive motivating force. They need to be challenging, but they also need to be attainable. Nothing destroys morale worse than when the boss hands down a budget or a goal that is just not attainable. It's impossible. And people lose hope. Okay, so they need to be challenging but attainable. And the employees need to be asked their input as the budgets or the plans are being prepared. So they feel like they have a say-so in how things go. It increases morale. Let's see, potential negative, pressure to meet budgets. Like if you give the salespeople sales budgets and sales goals, and you say, if you don't meet these goals, you're going to be in trouble. Well, employees are going to possibly commit fraud and unethical behavior just so that they can meet your unrealistic budgets and keep their jobs. Now, some people, if the employees are involved in the budgeting process, the planning process, then they might set the budgets low, right? That way, when they sell more, they'll look good, right? You need to try to avoid that. And this is something else. If you budget more money than you need for something, some employees are going to spend unnecessarily more money because they know they have it in the budget. These are things you need to look out for. But overall budgeting is good and it's very important. This is going to be what we're talking about today. There's a master budget, which is the overall budget for the company. And then there are budgets under that. So the master budget first, and this is very important. The first step in the budget is the sales budget. This drives everything else. The company needs to determine, through the marketing department and the sales department, they need to come up with an estimate of what we plan to sell next year. The production department will get that budget and say, okay, this is what we got to plan for. we got a plan to produce this many BMWs, this many X5s, this many Z3s, this many 325 ISs or whatever. So they come up with a production budget. And based on what the factory is going to produce, like how many cars, then they will come up with a direct materials budget, because God forbid you run out of materials, right? You don't have enough materials ordered and you can't meet your production budget. And if you can't meet your production budget, you can't meet your sales goals, right? Direct labor, we've got a plan maybe to hire more employees or let some go or increase overtime, or we can run 2 shifts instead of 3 or 3 instead of 2. Factory overhead, this is pretty easy. We kind of know up front what our overhead is going to be, but still we do one. But these 3 together, make up the production budget. And then we also have a cash budget and these budgets down here, which we'll talk about later. Let's start at the top, at the sales budget. Toronto Sticks Company, they make hockey sticks. I understand that a lot of hockey sticks are either made of wood or carbon fiber. Let's talk about carbon fiber because I think it's cooler. And they're basically that, right? They don't have a lot of other parts in them, just a big old molded stick. Now, this is a budget for the last quarter of the year. So we would have prepared this budget sometime in September, probably, because we want to have an idea as to what we're going to sell for the last quarter, October, November, December of the year. In September, we sold 700 sticks and we charged $60 each for them. They anticipate selling 1,000 sticks in October, 800 in November, and then a big spike in December as we get more into the winter, I guess, Christmas time and whatnot. And if this is what we charge, this is our sales budget, okay, 192. So this is going to go on our budgeted income statement for the last quarter. Again, all this happens during September, before this quarter. We're planning for the future. So we're going to put 192,000 on our budgeted income statement, because our goal is to come up with an ultimate income statement. So we'll know what our net incomes, or have an idea as to what our net income is going to be. Next, we're going to go to Connect and do number 1. I have got 8 of these problems that in Connect that we're going to do with regard to each of these budgets. So let's just do the first one. Grace Manufacturing sells digital cameras, and this is what we sell them for. Sales in May were 1,000, and management forecasts a 4% growth each month. Question is, that was May. So how many cameras do we expect to sell in June? Well, we sold 1,000 in May, right? And if you add 4% to that, what's that going to be? Now remember, if I take 1,000 times 1.04, and you get 1,040 units, 1,040 cameras. And since we're getting 250 for each of them, 1,040 times $250, that's $260,000. The next one we're going to do is 3. So based on the sales budget, we're going to prepare a production budget. Now, the production budget is a little more complicated because it's not as simple as saying, oh, well, we're going to sell, 3,200 sticks in the next quarter. So we need to make 3,200 sticks, right? Why shouldn't the production department make 3,200 sticks? Well, that is because, unexpected things happen. We need to plan for possibly, an uptick in sales. I would hate for sales to be better than this and us not to have enough. So when we build in our production budget, we're going to build in a cushion. We're not just going to plan to make 3,200 sticks. We're going to plan to make a little more, just so that we have enough to cover in case there's more demand. Now, this is the production budget, and this comes basically from the sales budget. It comes from the sales budget. Here's our budgeted sales: 1,000, 800, 1,400. That came just straight from there: 1,000, 800, 1,400. For October, since we plan on selling 1,000 sticks, should we make 1,000 sticks? Well, not exactly. First, I want to build in the cushion. I want to build in a cushion of 720 units. So I want to 1720 is the number I'm looking for, not just 1,000. But this 720 is a cushion in case demand is higher than we anticipate. And how can I get that extra 720? Well, usually it's just some mathematical process that they tell you. They're always going to tell you in Connect, we want to have a cushion. And this is called safety stock is what we call it. They call it desired ending inventory. I call it safety stock, and a lot of other businesses do too. Our safety stock is calculated at next month's sales times a certain percentage, in this case, 90%. This is what we want to have, 1720, not just 1,000. We want a safety in there. But there's also one more complicating factor. We had 1,010 hockey sticks left over at the end of September. So this is stuff we were not able to sell last month. So they're just sitting in there. Obviously, we need to subtract that from this because we don't want to make all these when we got these already sitting in there. So we subtract that number. So we only need to produce 710 hockey sticks. Now, for November, our budgeted sales are 800. And then we take next month's budgeted sales times the percent. Our safety stock or desired ending inventory, this is just our cushion, is 1,260 units. 800 plus 1,260 is 2,060. This is the number we're going for. However, we had 720, see, left over from last month, see, desired ending inventory. Now, I know this isn't true because we're still in September, right? So we don't really know how much was left over at the end of October. This is a budget. We're just trying our best to plan for what probably will happen. So we subtract that because, it's already there, right? So really we only need to produce 1,340. And then for December, you just follow the same process. Budgeted sales at the top, plus your safety stock or desired ending inventory of 810. So 2210 is our magic number, but we had this left over, or we expect to have this left over from last month, meaning that's our production for December. Zahn Company budgets sales of 220 units in May. Well, look, we're doing the May production budget. So they're giving you the budgeted sales for May. And then 240 in June. But we're doing May, so that's what I want. So our budgeted sales, we're going to sell 220 water skis. I don't care. We plan on selling this many skis, but obviously we don't want to produce just that much because we might have more demand and we don't want to run out. So we need to add some safety stock. Now it says here, each month's ending inventory should be, the ending inventory is what we want to have left over unsold, right? That should be 25% of next month's sales. Well, next month is June, that's 240. So 240 times 25% is 60. So I want to have 60. All right, they're making us do it step by step like we need to. We don't need all this. I guess they're what us to do. 240 times, it's 60. We already figured it out. So our desired ending inventory is 60. I didn't need to do all this. I could have just done that with one calculation on my calculator. Anyway, we definitely want to make 220, but then we want to allow for 60 extra in case sales are better. So that's 280. But don't forget, at the end of last month, we had 55 still in ending inventory that we hadn't even sold yet. So we want to subtract that out because we don't want to, those are already there. We don't need to make those. So really it's 280 minus 55. It's 225 units. That's our production. We want to produce 225 units in May. We have just done a production budget. I'm serious. There's a lot of manufacturing in this area. It's highly likely that if you're an accounting major, you're going to be doing one of these. If you're not an accounting major, but you're a manager of some sort, or even in marketing, you're going to be looking at budgets like this, and you need to know how they are prepared. Now that we have our production budget, we know that we need to produce this many in October, this many in November, this many in December. So we have our production budget. Based on our production budget, we can order our materials, plan our labor and our overhead. Because after all, aren't those the three components of any product? Direct materials, direct labor, and overhead. See, this production budget piggybacked off the sales budget. And then our next three budgets are going to piggyback off the production budget. So remember, 710, 1340, 950. Direct materials budget works very similar to how the production budget worked. This is from our production budget. Remember, 70, 1340, 950, 710, 1340, 950. Now, we have to order materials, right, to make these hockey sticks. We know that we're going to make 710 hockey sticks in October. Well, each hockey stick takes a half a pound of carbon fiber. Therefore, if we're going to make 710 hockey sticks and each one takes a half a pound of fiber, see pounds, we need 355 pounds of carbon fiber. Question, do we want to order 355 pounds of carbon fiber if our production is estimated to be 710? Well, I guess you could, but that's kind of dangerous, because what if demand increases and production increases and we run out of carbon fiber? Production is going to come to a screeching halt, isn't it? And then we won't be able to sell those. So we're going to order, just like before, we're going to put a cushion in there, or a safety stock, as most people call it. They call it, again, desired ending inventory. So we're going to buy 335 more pounds, just so we definitely have enough in case demand is higher. Oh, but hold up. I just checked the carbon fiber room and we had 178 pounds that we didn't use last month. So that's already there. So we don't need to order that. So I'm going to subtract that. So I need to order 512 pounds of carbon fiber. Now this stuff costs $20 a pound. So I'm going to plan on spending that much money to buy that much carbon fiber. And then for November, again, that's our production, half a pound each, so 670. They told us that our desired ending inventory is 50% of next month's amount. So that's just how we got that, okay? Just carry these over like that. So that's what we need. But remember, we had some at the beginning. So that's the pounds for November, December, multiply by the price or the cost, and that's how much money we need to spend on materials. So I think we should try one of these and connect next. Direct materials budget. Zortec budgets production of 400 units in January, 200 February. Well, we're doing the January direct materials budget. So we're doing this, to meet January needs for direct materials for our January production. Now for January, we plan to produce, it says 400 units. And it says each unit requires 5 pounds of material Z. 5 pounds, right? Materials required per unit, right? Because that's the number of units. That's 5 pounds per unit, right? So I need to have 2,000 pounds of materials to make 400 units. But what do I need to add to that? I need to add to that desired ending. Like, how much materials do I want, as a cushion, as a safety stock, extra, just in case production is higher? How would I calculate that? Let's see, it should tell us here, right? Each month's ending inventory of material should be, here we go, 40% of the following month's production. Now they want this in pounds, so be careful. Next month, it says 200 units, right? So let's see if we can think through this. We're going to make 200 units in February. What's 40% of that? Yeah, times 0.4. That's 80. So 80 units basically, and how much pounds per unit? See, 80 times 5, right? That's 400 pounds of material. I could also have done this 200 units times 5 pounds. That's 1,000 pounds, right? But only 40% of that. And that's, again, it's still 400 pounds, no matter how you look at it. So this is cool, right? However, I believe we started off the month with some materials that we already have in stock, so we don't need to buy that amount. Yeah, it says we had 800 pounds to start with. So we definitely don't want that. So we're going to subtract 800 off of it. So really, we only need to purchase that much material. And of course, the cost is $2 per pound, it says up here, cost $2 per pound. So that's how much money I need to plan on spending for materials in January. This money doesn't grow on trees. You know, the company needs to make sure we have this much money set aside to buy materials, right? So all this is coming down to money. Are we going to have enough money to run the business, which we'll see at the end with our cash budget. The next one we're going to do is 6, and this will be easy. The direct labor budget isn't that bad. Again, the direct labor budget also comes from the production budget. So this is our production. We've budgeted that each hockey stick requires 0.25 hours, or what is that, 15 minutes. So each hockey stick takes somebody 15 minutes to make. So that's a total of 177.5 hours to meet production in October. And that's just it, okay? We're paying them $12 an hour, so that's the cost. You don't have safety stock. I mean, you can't have labor left over or labor left over from last year. So the direct labor budget just is, it is what it is. So in this case, we plan to produce that many units. And how long does it take to make each unit? 2 hours. It takes 2 hours to make. So we need, what is that, 2 times that? So it's 2,040. Okay. So yeah, total of 2,040 hours, because we're making that many, and each one takes 2 hours. So it's that many hours in total. So we might need to hire more people or schedule more overtime, okay, to meet this, because this is the hours for 1 month. And of course, how much we paying these people? $20 an hour. So that's the money we need to make sure we have. We need to make sure we have that much money to meet July labor costs. So the next one we're going to do is 8. Zilli Company budget sales of 400,000 in June. So then obviously that comes from the sales budget, right? Not the production budget, just the sales budget. We pay our sales manager a monthly salary of 6,000. So that's fixed costs, right? But they also get a commission of 8% of the sales dollars. So if budgeted sales are 400,000 and the sales commission percent, they tell us is 8%, how much are we going to probably shell out given that the salespeople sell for that, and we got to pay them a commission of 8%, $32,000. We need to make sure we have that set aside. And of course, we also need to pay the managers 6,000. This is 38,000 total. The next one we're going to do is number 11. Now we're getting to the cash budget territory. So we're in the home stretch of all this. And again, this is common sense, I think, but it's probably something y'all haven't thought about too much. So it still might be a little confusing as we go through this. But I think if you really pay attention, it's going to make sense to you. And this diagram is the backbone of the whole cash process. So we've already done the sales budget, the production budget, all the other budgets. Based on that, we need to see if we're going to have enough money to pay for all this stuff. What we do with the cash budget, we take our beginning cash balance and we add what we plan to receive minus what we plan to pay. If this is negative, we're going to need to plan to borrow some money. If after all this, we end up with what's the word, like a surplus of cash, extra cash, then we can repay some loans that are outstanding, to reduce our interest expense. All right, the next one I want to go through is number 12. This one is involving the loan activity. So this one's pretty important that we go through this one. Santos is preparing a cash budget for February, and there's February. The company has 2,000 cash at the beginning of February. We have 20,000. That's the money we got at the beginning of the month, left over from last month. And we budget 75,000 in cash receipts from sales, and that's cash received, and then this much cash payments. So cash receipts from sales. So this is the total cash that we probably going to have available. But then we're probably going to pay 100,250. $95,000 minus 100,250. That's negative 5,250. Type the net minus sign, 5,250. Be sure you type the minus sign. So then the company maintains a $5,000 minimum cash balance and will take a loan if necessary to maintain this balance. We have no loans outstanding, so we don't have anything to pay at the moment. Do we need to borrow some? Yeah, so we need to borrow. We really need to borrow, so 10,250. Yeah. And we want to have an ending cash balance of 5,000, right? Mm-hmm. It's weird how they're making us do this. Okay, I think it looks strange, but I think that's right. Yeah. Okay, this is presented a little weird, but yeah, that's what we end up negative. So we got to borrow 10,250 just so that we end up with 5,000. And yeah, because we borrowed that, we owe 10,250 because it says we didn't have any outstanding loans. So this is just all we owe at the moment. If they had said we already owed 5,000 or something, this would be more. Yeah, I think that's pretty much it. I did tentatively have 19 flagged. It's not that hard. It's just a budgeted income statement. But I'd like to see you tackle this on your own. It asks you to do a budgeted income statement, but you've got all the information here. You're basically plugging it in down here. This chapter isn't too bad, and the next chapter isn't too bad either. All right, y'all have a good one.